This program is brought to you by IG. Trade over 12,000 shares and ETFs, including major tech giants with extended hours on an award-winning platform. IG, where traders are made.
Hi, welcome back to Ausbiz Live from our Barangaroo studios. You have tuned into the call. 10 stocks picked by you. I put those stocks to our expert panel. We do it all in 1 hour. I chuck in a stock of the day. Let's bring in the panel. Luke Larrative from Seneca Financial Solutions. Luke, welcome to the call. Good to have you aboard.
Thanks, David. Nice to be here.
And you're teamed up with Shawn Hickman, who's not a bad bloke either, from Market Matters. Shawn, how are you, mate?
I'm great, mate. Nice
Good
to be
weekend.
here. Great weekend. Too short as always, but this one coming up a bit longer.
And the market's got it right again today, up again on a Monday.
We like the market. I think it's going up.
Yeah.
As simple as that. I think I've been saying it every time you ask me. We think the market's going up. Just remember, it's 3 steps forward, 2 steps back. Stock sector rotation, but the index itself looks healthy.
Yeah. Luke?
Yeah, I'm bullish. I think it looks good. Earnings revision's going up higher. Bond yields maybe coming down. So looks pretty good.
Because with the Magnificent Seven in the United States, you can't, I'm old enough to remember the dot-com crash, and then at 2000s, what was that? E-Corp, wasn't it? I think was
before my time, Koch.
Well, yeah. No, it was a poster child. Had a market cap bigger. It was sort of like an early Amazon, supposedly. Had a market cap bigger than Woolworths and no revenue at one stage. So I started to get really nervous about it. But then I saw analysis on the weekend saying, if anything, the Magnificent Seven were undervalued.
I was going to say, I don't think...
When you look at their earnings,
I don't think
actually delivering.
Don't think it's comparable. I think the valuations actually look pretty reasonable if you start to look at it's the astronomical growth that's kind of scary.
Yep.
And obviously if the earnings start to come down or there's a blip, sure, then maybe these stocks will look expensive in hindsight. But I think on a pure numbers basis, it's not actually that analogous to the dot-com.
And I think their revenues are shooting the lights out.
And I'd say make it the Super 6, take out Tesla.
Right,
They look great. They look really, really good. They're making a lot of coin. The valuations, actually, if anything, they are quite cheap.
Yeah.
Before we take into account growth, there's no reason. Maybe Apple's getting a bit up there now. The growth for Apple could be a bit clouded.
Right.
But I think it's a sector where you can just pick your way between them, and they look quite good. They look really good.
Certainly leading the markets, isn't it? Hey, let's take a look at the, just run through the first 5 stocks we're going to be covering this half hour. GQG Partners, PEXA, Reliance, Sayona and Index. Stock of the day, high profile, not terribly great performer on the market since it floated. McGrath Holdings, Sydney real estate operator John McGrath, it's his listed company, is in talks to sell the listed agency to global property giant Knight Frank Bayliss. Under the deal, McGrath shareholders will have the option to receive 60 cents cash per share, or an unlisted scrip alternative in sort of they're going to take it private, so you can stay part of the private group, or a combination of both. If successful, it will mark the end of McGrath being a listed ASX company. Share price currently up 20% today, basically close to the offer price of 60 cents. John McGrath said he's going to convert his shares into shares in the private company. Shawn, if you're a long-suffering McGrath shareholder, what should you do?
I'm not, fortunately.
Yep.
I didn't know what the stock was going to be today, but look, we've never traded McGrath.
Yep.
Fortunately, never been invested in it. My gut feel says take the money.
Yep.
And step aside and look elsewhere. There's plenty of good opportunities out there. I'm not a huge fan of going off market. I'd rather have something that's liquid. I can see what it's trading. It's more transparent.
Yeah.
That's my personal ethos. Not everyone would agree with that.
It floated with a blaze of glory, didn't it? When was it? About 4 years ago?
4 or 5 years ago. I'd hate to think what the capital depreciation has been over that time.
Yeah.
Your chart doesn't go back that far, but it's going to be one-way traffic.
Yeah, exactly.
Like a ski slope.
So take your money and run.
I would, but I haven't researched it in great depth. It's not a stock we've traded or owned.
Luke?
We don't own it. Never really spent a lot of time looking at it until today or this morning when you sent me the email. But I think it's a business that's sort of like stockbroking or these businesses where the goodwill in the company goes up and down the lift every day. It's with the people that work there. It's not so much the brand.
Yep.
And I think as a result, they're generally far better private companies than they are public.
Yeah. You make an interesting point with a lot of financial groups who've been taken over in the past, and then you see a mass exodus of all their biggest producers. And it's a reminder that yes, they might be a listed company, but they're depending on really high revenue producers to deliver their bottom line, aren't they?
Yeah, for sure. I think like the legal industry is another good example where we've tried over the years to have listed partnerships. They just don't work, whether it's consulting, financial services or legal. I just like a partnership model in a private sort of arrangement, for lack of a better word. And I think for the Knight Group here, the buyer, they're going to be probably doing really well out of this because it's cheap assets, it's a cheap business, probably decent cash flow. But probably just not the right place for it, the ASX, in my view.
Yep. I'd even throw the key man risk in with fund managers, which is the first subject we're talking about today. First stock, if the people at the top giving you the correct pointy end returns leave, what's left?
Yeah. As we've seen with
Magellan.
some high-profile fund managers, exactly. All right, let's take a look at the stocks you want us to take a look at, and as Shawn hinted at, the first one is a fund manager, GQG Partners. Julian wants a view, Shawn. The global boutique asset management company has clients that include pension funds, headquartered in Fort Lauderdale in Florida. Also New York, obviously Sydney, London, Seattle.
Okay, why not? I haven't been to Fort Lauderdale, but I'd imagine it's a nice place.
Yeah,
it sounds like it, doesn't it?
Tax deduction over there, Shawn.
Look, this is a really good company. Last year, their flagship fund, I think it was 20.9% return, almost 21%. It's attracting money. Funds going in, very different to some of the other fund managers. And while that's maintained, it looks really, really good. The numbers are fairly cheap. It's yielding well over 6%. I think it's on about 13 times at these prices.
It's almost doubled since October.
Exactly. They're doing it right. And while there's key people stay in place, keep knocking out those returns, it looks really good.
Okay.
I use the word when. Assuming they do stay in place, it looks really good.
Right. So what makes them different to, say, a Magellan or a Platinum or...
Well, the people. I mean, we've already talked about it. The Magellan have lost their figurehead.
Yeah.
And it went a bit pear-shaped before he left. So there were problems in the background there. We'll never fully understand or know what went on. This is the opposite. You've got a fairly new company and people are driving and they're striving to get the returns, and they look really, really positive. It's early days, isn't it?
Early days, but so these are sorts of stocks you can't set and forget. You've got to keep following them to make sure their key people stay there. Is that what you're...
Well, we're active fund managers, David, so we don't really believe in set and forgetting a lot of things.
Right.
You've got to evaluate, even though it might be the best company in the world, it's at what price. We've seen that from, say, CSL.
Yep.
The best companies can have big 30-40% pullbacks.
Yep.
So in this particular case, while they're doing what they're doing at the moment, we like it, we think it looks good.
So even a buy at these levels?
I would not be a buy at these levels. I'd like to buy it 5 or 10% cheaper, but who wouldn't always say that in the mix?
Yeah, exactly. Lou?
Yeah, look, we've owned
GQG.
We've owned GQG for a long time. So, we bought it for our Australian Small Companies Fund at $1.30 just recently. We really like the, I suppose, comparison to a Magellan or a Platinum. I think that's quite instructive. Valuation here is cheaper than both those businesses, despite those businesses going backwards in net flows, and GQG is just continuing to kick goals. As Shawn alluded,
hang on, its valuation is cheaper than the other two.
So that's even now, right? Like it's still on, probably not now, maybe similar PE now.
Right.
But if you go back to $1.30 when we bought it, it was way cheaper.
Wow.
And it just been, after IPOing, it really just did get dragged down by the sort of negative sentiment around Magellan and the whole sort of active funds management sector in Australia more broadly. We saw that as an opportunity. As Shawn said, they've done exceptionally well, whether that's the emerging markets fund or the global equity product they run. They've recently announced they're going into private markets, which we think is super clever. There's a lot of private wealth money chasing private capital, whether that's private credit or private equity at the moment, and we think it's a growth area for them. They're going to hit 150 billion FUM in March. it's still cheap as far as we're concerned. Growing 20% per annum, 8.5% dividend yield. So it's ripping.
8.5% dividend yield.
Yeah.
Okay, you disagree with Bloomberg, but
It's
we'd call it very healthy anyway.
Yeah, big.
Right.
Yeah. And I mean, that's up sort of 17% on last year. So,
Right.
you know, from a factor perspective, dividend growth, great factor to kind of be paying attention to
Yep.
in terms of, you know, demonstrating a business doing well. And, you know, we can see GQG going much higher from here.
So Shawn says it's all about the people. What impresses you about the people?
No doubt, CEO Rajiv's a really impressive guy. I think what's more relevant, I think their investment process and investment team is really important. I think what's unique about them is they deliver, you know, top quartile returns for bottom quartile fees. So if you look at what's charged for a global equity manager, you know, in Australia, in this country, it's about 90 to 110 basis points. You know, these guys are in sort of 50 basis points kind of territory. Emerging market strategy, again, it'd be 120. These guys are sort of 75, 80. So I think you're getting really good product for a pretty low price. And I think coupled with that, you know, 90% of their business is in management fees. So that's recurring monthly fees. They're not reliant like a Platinum on performance fees to drive their earnings. So I think that's what makes it a better quality fund manager. And I think that's why it's going to trade on a premium for those businesses.
So you'd have them as a buy as well?
We've got it as a buy, we own it. Yeah.
Okay. All right. Okay, let's Sedana. Luke, what's a view on PEXA, the digital conveyancing platform for real estate settlements in Australia? It was hyped out of Link, wasn't it? Link Administration.
Yeah, it came out of the
wasn't
banks
it?
and the registries, yeah.
Yeah. One of the registry groups.
It does sort of 90% of property transactions in Australia, settlements and conveyancing.
You'd think that'd be a no-brainer, wouldn't you?
You would. We own it, so it is
Right.
it is a no-brainer from our perspective. It's on about sort of 20 times EV to EBITDA, does sort of 60% margins, and we kind of liken it to a net wealth or a hub. Who we see as having like less market share, similar sort of business structure, similar sort of forward profile, for lack of a better word, but they're on 34 and 24 times respectively. So it's kind of cheap relative to those in our view.
Right.
Their main opportunity though, you're kind of paying for the Australian business, which is growing and, you know, good margins and a good market share and monopoly really. But the UK is where they're going. And the UK market's 2.5 times the size of the Australian market.
Right.
And there's no real digitisation there on conveyancing and settlements yet. It's still really early doors. So it's like Australia was 10 years ago.
I know, it's horrible.
Yeah, all the property you're buying over there.
No, I've got my youngest daughter lives there, and they've just sold in Brixton. They say they're now becoming adults and buying in Broccoli in London, and it's taking forever to get the thing done. And I said, "You're kidding me? What's happening?" She said, "Just the way it's always been done."
Correct. So, you know, they're going through a process of trying to, I suppose, become the monopoly in the UK. Now, I don't know if they're going to be able to achieve that, but on our numbers, like, they get a smidgen of the market share over there, given the additional scale. We think there's significant upside to earnings here. Stock's run a little bit since we bought it. I think it's like $13 now. What is it? Yeah, 13, 15. But there's probably 30 to 50% upside here still if they get the UK right. Now, the risk is you end up with just the Australian business left over. And from my perspective, that's fine. I paid 20 times for a decent kind of tech business with recurring revenues.
Right.
Not so bad.
So you're saying it could get back up to those $19 levels?
Yeah.
That it was
I would
a couple
say
of years ago.
And then if that's the case, probably housing volumes in Australia have turned around and are picking back up again. Housing volumes in the UK probably look good. Yep. And maybe they're growing market share in the UK as well. So could be a real kind of Goldilocks environment.
So buy from you?
Buy from me, my friend.
Shawn?
Well, we own it as well. So hopefully this isn't going to be a boring situation where we both agree with each other. But we own it in our emerging companies portfolio. We think it's a buy by definition, otherwise we wouldn't own it. It is, to me, the valuation is all about that UK side of things. Australia is firing, it's going really well, it's the bulk of their business. They recently bought a surveying company in the UK. When the UK wakes up from the dark ages, and it will, we all know it will, if they get the right market share, you've got all your blue sky. As Luke said, if not, you've got a solid business and you won't lose money. Or you shouldn't lose money. I won't say won't lose money. And you're well positioned. But there's a lot of really good blue sky there. So we like the stock as well.
Because I had this other thing, Georgie was explaining that there's that whole ripple effect of who's buying what from who and getting the timing right. So settlements are delayed. you know, if you get your timing wrong, and we've all done it in the past, you're out of a house for a month or 2 months, you're just going rent. But over there, everyone has to wait until...
I've done it. I've been there. You're in a chain.
That's what it's called, the chain.
They call it a chain.
And
if there's a chink in the chain, and there often is, you're in trouble.
And she couldn't figure out why on earth they did it this way. She said it's so clumsy.
It's why there's a bit of a flywheel effect for this business too. So, you know, once one agency or one legal group are using it, then they want everyone else to deal that way. So it sort of starts to sort of feed itself a little bit. So I really like PEXA. It's a bit of a pet stock for mine.
Yeah, okay. Will the English change quickly though, Shawn?
Quickly is a big word. They will change. On the weekend we got asked for our favourite 3 emerging company stocks, and that was one of our favourite 3.
Is that right?
Yeah.
Oh, okay, all right.
So we're putting it up on the pedestal there.
Yeah, you certainly are. All right, our next stock. Will you put this on a pedestal, Shawn? Reliance Worldwide, the big Australian-owned plumbing and heating products group, now in. It's massive, 14 manufacturing plants worldwide, 30 international distribution centres. When you talk about plumbing organisations, this is massive.
It's pretty hard to comprehend, isn't it?
Yeah.
You know, and
I didn't realise it was just that big.
Yeah, it's huge. And their recent result was a 5%, the first half, 5% beat on the EBIT level.
Yeah.
The stock looks good, looks to be going up. I wouldn't put it in the same growth area as someone like PEXA for obvious reasons. But it was a US result that delivered.
Right.
You know, the US side of the business has been delivering.
And that's that big blip up there in February.
Exactly. It delivered very, very well. They've also recently bought a company called Holman, a plumbing acquisition, and that should help them get potentially sales into Bunnings, which will be even better for them. So we can see some blue sky there in the stock. We do like the stock here. I'd be buying into any dips before 550, towards 550, and the risk reward will look okay.
Okay.
But we don't own it, and we don't plan to buy it. I stress that.
Right.
But if you ask me to say buy, sell, or hold, I would say buy, especially into small dips.
Okay. So buy into dips around 550.
Yep.
And look, the issue the last year, 18 months, hasn't been on Reliance. How successful will that move into the US be?
They've got a pretty successful business in the US. I think what has been more relevant for investors is kind of the macro of the renovation market in the US in particular over the last, with interest rates doing what they've done. Look, there's been a flurry of activity in building mats, of recently, whether it's CSR, Boral, Adbri, all kind of getting bids, stuff going on. So I think
take them over.
I think that you're starting to see some of these bigger groups trying to take advantage of this cyclical downswing in the market.
Right.
And I think
will they be will Reliance be a target?
I don't think they're a target at the moment at the current valuations. I do think the values are kind of getting a little bit stretched. We still own it. We have owned it for a while. I like the on-market buyback that's in place. I think that's obviously supportive for the share price. I think the acquisition on 7 times of Holman Industries, who you might know they make the hoses at Bunnings and stuff, seems pretty good given stocks on kind of 12. So like it, like Shawn said, probably a little bit less upside there than maybe some of the other things we've talked about so far. But certainly really high quality business, pretty good moat, pretty good management team established in the US.
So more a hold from you than a buy.
Holdy buy.
Holdy buy. Holdy buy. That's a new one. I like that one.
Well, Kevin Rudd wants to build 1.2 million homes in the next 5 years.
Right.
It's going to be a pretty busy space going forward.
Well,
if you can find the tradies.
Yeah. But that's the issue. In Australia, isn't it? We need 250,000 new homes just to meet supply a year. Last 12 months, 175,000 were built. Next 12 months, only 160,000 approved.
And before we get started,
so house prices aren't going to come down anytime soon.
No, and we need infrastructure too.
Yeah, I know.
And we know how long roads get taken to build and how much their cost blows out.
Yeah. So governments have got to get their act together and sort of start encouraging all of this. All right, let's go lithium producers. Chris wants a view, Luke, on Sayona, the emerging lithium producer in Quebec in Canada. They have a project there, and also in WA.
Yeah, the main thing is sort of the North American lithium project, as you mentioned. I think their deal with Piedmont, where they sort of can only sell half the production at 500 to 900 US a tonne, kind of caps the upside here. I think if you're trying to get exposure to a rebound in the lithium market, which is certainly sort of our view, there might be better ways to allocate capital than Sayona, given the pricing mechanism they've got in place.
So they've locked their sales into
like
another
a
company.
fixed little ratio, yeah. So Piedmont PLL is the company that gets the offtake. And look, I think there's probably I've got a few concerns around like cost control over a sort of longer mine life period, where previous owners have struggled to make the economics of that particular deposit work. So I'm not sure necessarily NAL is the one for them. Maybe this Mobland thing to the south, the DFS looks pretty interesting for that, 2.2 bill Canadian MPV at a reasonable cost. But again, a few governance issues with this company over the years, few suspect capital raises, CEO's left, sold all his stock. I don't know, just got a bit of a funk about it as far as I can sort of feel. Probably look elsewhere.
So not for you.
Nah, self-announced.
But picking up your comment a bit earlier, you're a bull on lithium
Big time.
and a bounce back.
Definitely.
Why?
I just think the supply-demand dynamics speak for themselves. That's kind of my background, is supply-demand modelling for the coal sector. I sort of see a lot of the same analogous kind of market dynamics we had in 2014 in coal, with the indexation, futures, and financial sort of creation, I suppose, of that market. I think lithium's going through a similar phase, seen similar levels of volatility. I think long-term, the numbers don't lie, so it should sort itself out in due course.
Okay, so what are your preferred lithium stocks?
I think you've got to kind of break it down among kind of those that are in production, where you're buying cash flow and decent management, and then those that are sort of not in production, for lack of a better word, where you're buying a project, hopefully at a discount to what you think fair value is for, like Sayona. Yeah. So among the producers, we like Pilbara and Arcadium Lithium. We think particularly is undervalued at the moment, LTM. In the developers, whether it's a Vulcan Energy Resources in Germany, we really like. It's a Galan Lithium in South America, we think super cheap. There's probably a handful of names there that are...
So if you're looking for an explorer with potential like Sayona, go Vulcan.
In my view, yeah, much better management team.
Okay. What do you reckon, Shawn?
I'll read out what I wrote down before we got in here today. Looks horrible, leave alone. So I don't want to waffle about that. Oops, a daisy.
Hang on.
I think I might have actually done some serious damage there.
All right, let's. We'll get someone in to fix the microphone for you, and while we're doing that, we'll come back to you. But in the meantime, Luke, why don't you run the ruler over Index? Tanya wants a view on that, the Australian Mining Equipment and Technology Company.
Tanya barking up the right tree here, Kochie. This is the beauty of this business.
Right.
So I really like this company. They do drilling technology, essentially. And that business, they operate for about 60% of the world's largest mining companies. So made a recent acquisition, which, in my view, looks really good, and has sort of consolidated their position as the number one provider in this sort of drilling tech space. They're pretty exposed to gold drilling and gold exploration. Gold price is pretty high at the moment. So expecting that to sort of continue. Rig availability is kind of falling in that space, which is good lead indicator for Index. And business is sort of flying, had a really good result. But I think, it's still, it's pretty cheap and well worth people's paying attention to. Okay,
so it's had a bit of a bounce, as you can see in the last couple of months. Worth buying at $2.31?
Yeah, I think it's worth like $3 plus.
Ah, okay. So this is your classic picks, and when they talk about don't go miners, sort of invest in the picks and shovels producers rather than miners themselves. Is this a classic example of one?
Couldn't say it better myself.
Right, okay. Shawn, now we can hear you. You've got your microphone back. Let's finish off on Sayona.
Okay,
for us,
so
and lithium in general.
Lithium in general is far more interesting.
Right.
We had a good year last year because we didn't have any lithium in our portfolio. Left it alone. Well, we had a bit mineral resources, but fundamentally we left it alone.
Right.
Recent weeks we went and bought Pilbara. We think lithium's now cheap. It's going to rally, but we kept it simple, stupid, and we bought the one that makes money.
Right.
Simple as that. So we're probably not quite all in if you're playing poker, but we think lithium stocks down here will give you a good return over the next 6 to 12 months. And Sayona might halve again, whereas we don't think Pilbara will.
Right. Okay.
So we like lithium down here in summary.
Okay. So it's with all commodities, it's all about the timing and where you are in the cycle.
They're cyclical.
Yep.
My background is being a prop trader, so I quite enjoy being in this space.
Yeah.
but you'll be very happy to be out for a long time as well.
All right.
And that's been the case. And now we've got gold's running and uranium's running. There's plenty of things moving.
Yep.
You don't have to be fixated on one area all the time.
Yep, which is a good thing.
Yep.
All right, and Index.
Like it.
Your view
I
on
think it's a
Index?
good company. It's, what do we call it? We call it a mining tech company. It does things like drilling optimization. It's a quality company. It's market cap well in excess of $1 billion. Yet a lot of people wouldn't know much about it.
No.
I think at $250, $3 all over it. Obviously, $250 is not that far away, but it's a good quality company. We like it. The first half result was strong. I think on the day the stock popped 17%.
Yep.
Historically, stocks that do good results, they tend to keep on going.
Yep.
Nothing about the stock we don't like.
Okay. So is it dependent on the health of the mining industry, though? You were saying, uranium has potential at the moment, lithium, gold's running at the moment. So, commodities is a bit of a sweet spot.
It is, but you've got to look at the fact that we've gone through, everyone knows now that we're in a cyclical situation, okay, with commodities. Iron ore is a great example, it's more than half, blah, blah, blah. So these miners are being more careful with their money.
Right.
So if a company like this can come along and help them with their drilling results and make them more, optimize what they're doing, it actually is worth spending more money with them.
Right. Okay.
As opposed to the price of gold has to go up. The price of gold, sure, they make more money if more gold mines open.
Right. Okay.
That goes without saying.
Yeah.
They've still got plenty of work there if they want to make these gold mines more efficient. And one of the most frustrating things, if you're talking about gold, is the gold price all-time highs last week.
Yep.
And the gold stocks are pretty horrible.
I know. Why?
Interest rates is probably the biggest one, bond yields.
Yeah.
But a lot of them, the old Newcrest was a great one, they would disappoint every time they reported.
Yeah.
I think labour costs too. Like I find like the gold mining companies are generally more of a warrant on Western Australian labour costs than they are on the gold price. I think there's much better ways to play it, and certainly from our perspective, Index looks like a ripper.
Right. Okay. All right. Buy for you, Shawn.
Yes.
I have another daughter who lives in Perth, and it just fascinates me on a Monday morning when you fly back to Sydney from Perth. The queue is for security is out the door, all in high vis, and on their jacket they're Pilbara, BHP, the whole thing, and you sort of start to chat to them. Oh, how's it going? Well, which mine are you at? It's fascinating, but it is like a bus when you talk about the cost of labour, but they're just flying everywhere. The old FIFO is absolutely huge. All right, let's recheck the first 5 stocks, including our stock of the day, which is McGrath, which has had a takeover offer from Knight Frank. Basically, the theme from both Luke and Shawn is take your money and run. GQG, the boutique fund manager, a buy from both of them. PEXA, the online conveyancing platform that's expanding into the UK, a buy from both as well. Reliance, good company, share price high at the moment. Shawn, if it dropped back to around the 550 mark, which isn't a big pullback, but a bit of a pullback, he'd be interested in buying. Luke's come up with a new one, a holdy buy, which is a hold sort of skewing towards a buy. I think if it pulls back a little, that could tip you over the shoulder. Sayona is a no from both. In that same category, a lithium explorer, Luke likes Vulcan. Shawn is bullish on lithium at these levels. It's had the big correction down, and they've recently bought into the market leader Pilbara, and Index is a buy from both as well. Here on the call, we've been tracking our own high conviction fantasy fund as picked by the investment committee. The latest episode of the committee meeting is live for you to watch at ausbiz.com. Let's check in with the portfolio going into March. Altium and Johns Lyng were sold out of the portfolio. Domino's and Evolution added at 4% and 5% weightings respectively, and the portfolio currently up 28% since March 2022 when it started. So keep sending in your requests for the call because any stocks that get 2 buys or 2 sells and is in the portfolio already goes back to the investment committee. So today, GQG, PEXA, Reliance, Yes, a holdy buy, we'll make that a double buy, and index will go to the investment committee for see whether it should be put into the portfolio. This half hour, Aurora, Global Data Centre Group, Lend-Lease, ANZ and Corporate Travel are on the agenda. Leo wants a view on Aurora, the big global packaging and distribution business. It's the old Amcor, isn't it?
It was part of Amcor. It's been spun out. Yeah. Yep. So generally like sort of spin outs as a general comment. I think.
Why? Why do you like spin outs?
I think they end up being run better as a spun entity, a bit more focused.
So it's the South 32 theory.
Not South BHP. 32, but maybe something else. But yeah, I think this business has been, I suppose, put on watch by the market for this Saverglass acquisition.
Right.
I don't really have too much negative or positive to say about it. It's kind of one of those ones we'll see. The synergies in the deal were probably a bit light on from my perspective if I was going to be advising them on M&A. But the core business is kind of going okay. They're making some investments. Probably have to take a long-term view if you want to buy it here or you're really holding it here. For me, probably a hold. Not in our portfolio. I don't own it.
Right. Okay. You don't sound too enthusiastic about it as
being
a stock
nice.
anyhow. Yeah, you are being nice. Sean, are you going to be as nice?
No, the gloves are off at last. We've got it as a buy. We own it in both our active.
As a buy?
We own it in our active growth and our income portfolio since the capital raise.
Right.
Okay, we think it's offering good value down here. Sure, it's a very big play into Europe. It's a very, very big play into Europe. We think it can be a game-changing play. We like what they've done.
Game-changing?
Yeah, well, it needs to be. What they've paid. They've paid a lot of money. I think the synergies aren't too bad. The question mark was always about how much they paid. They might have paid a slightly rich price. Time will tell how well they dovetail the two businesses together. But I think at these levels, it's paying about 4% per annum. It's a longer-term play. Right. You have to see how this plays out. Okay, it's not going to happen overnight. That's one of the reasons it's in the income portfolio, but we think there's good value here for the growth. So we've gone long, but I've even written this down. In focus now, but longer term, we think this can turn around nicely.
Okay, all right.
I mean, look, it's also come down a long way. The capital
raise
raise
has.
The capital raise brought it down a long way.
So is that the sharp cliff fall there when
Indeed.
it came down? Right.
Indeed.
Okay. But they always say do a capital raise at the top of your market. They actually timed it all right, didn't they?
They did do it very well. They do it very well. Let's wait and see how well they bought.
Yeah.
It's one thing to raise money. Then what you do with it is obviously the other thing.
Okay.
We like what they bought. We like how it can work together.
Okay.
But they are running a slightly different business. It's you're talking. It's a upmarket glass business they've bought.
Right.
So they have to make sure they can really maintain the management there, maintain the oversight of that business they've bought into.
Okay. All right.
But we like it. We think it's good value at these prices.
Okay. All right. Ram wants a view, Shawn, on Global Data Centre Group. They invest in digital infrastructure assets. So is this like a data centre REIT, is it?
Effectively, that's what I would call it. Look, we don't, it's a $170 million business. It's a bit small for us.
Right.
So we don't, this was the first time I've really looked at it when the list came through last week.
Yeah.
So I looked at it technically and I thought, well, it's breaking out to new highs. Risk reward makes it very hard to buy it. We love the sector they've gone into, data centres. We own Goodman Group. That's paying great dividends for us so far, the way they're evolving in that direction. So you class that
as a data centre?
Well, that's what they're trying, no, a data centre exposure.
Right.
It's a big difference, you know?
Yeah.
So we like the direction they're moving.
Yeah.
We don't know a great deal about the business, but technically it looks good.
Right.
It's not what I'd be buying for data centre exposure, but I can't read, anything I read about it, it's not actually something I dislike.
Okay. So if you're in it, hold?
If I was in any stock, mathematically any stock breaking to a new all-time high, you're better off holding. Yeah. And that's what it's doing. But it's an investment company. As I say, I do stress, we don't know a huge amount about it.
Okay. So look at that, from $1.10 to $2.21, had a good run. So is Goodman your data centre exposure, or are you into NextDC as well?
We've decided for Goodman Group is the way to go.
Right. Okay.
And it's only part of what they're doing.
Yeah.
You know, but we like, you know, it's
mainly known for industrial and the wholesale.
Totally, but it's the direction they're going for the next level of their growth.
Right.
And it's such a quality business, we think they'll get it right.
Yep.
They've certainly got the locations for it. And obviously data centres are going to be a big beneficiary of AI.
Yep.
The need for it.
Yep.
So yeah, we think this could be a good little play.
Okay.
But I keep stressing, keep repeating it. We don't know a lot about it.
Right. I was reading a great stat last week. Data centers, AI data centers, and Bitcoin mining use
I know where you're going with
the
this.
same amount of energy as Japan
Yeah, I was going to say,
in a year.
I thought you were going to compare it to a coal mine, but yeah,
No.
it's huge amount of pollution.
Absolutely, and it's everyone sort of targets airlines, but the international airline industry does not produce as much, have as big a carbon footprint as data center
No.
sectors. It's phenomenal.
But it wouldn't get the clicks.
No,
It wouldn't get the clicks in the paper, would it?
Exactly right. Exactly right. Luke, what do you think of this group?
Yeah, we know it really well actually, sort of, and own it. So it's one of our biggest positions in the Seneca Australian Small Companies Fund. So kind of.
Why?
What did you let me waffle for that time for?
I was trying to be polite, show the respect. So like the primary asset they've got is a 1% stake in AirTrunk, which is like a hyperscale, massive Asian data center thing that's owned by Macquarie, or part owned by Macquarie. That's going to probably IPO this year, and that's going to be, 20 to 30 times is what EV to EBITDA is what the comparable companies around the world are trading on, including NextDC, which has been ripping lately. There's some really interesting incentives if they can achieve sort of higher valuations where GDC receives, millions of dollars essentially in cash payments. It's going to be really interesting to see how this IPO does go. I think GDC could be, $3 plus on the back of that. We own it, like I said, we really like it. It's been a positive holding for us without a doubt, but we think that liquidity event is this year. I think the Reddit IPO just recently has kind of opened the IPO window, and I would not be surprised with the performance of some of the other data centers around the world if AirTrunk wanted to go this year, and that the owners of that would want to see that go public, and I think this stock is significantly undervalued.
Okay, all right. So you have it as a buy.
It's one of our biggest positions.
Sorry?
One of our biggest positions.
Okay. Just explain what AirTrunk is for those who don't know that's coming up.
Okay, so the data center market's sort of in three kind of categories, for lack of a better word. You have your edge data centers, which would service, say, like a market like Wollongong or Bendigo, small regional. Then you have your sort of normal scale data centers, for lack of a better word, which service the capital cities. And then you have these hyperscale data centers. They're, multiples of what you would think of a NextDC is.
Yeah.
NextDC is in that mid-market. And then you have the sort of Equinix and AirTrunks who service these massive Googles and Microsoft. They're the ones with exposure to AI.
Right.
Not building a shed at Derrimut. No, it's the guys who are at these massive data centers in Asia.
Wow, that's interesting. And they've got 1% of it.
They've got 1% stake in it. Yeah, GDC.
Gee. All right, our next stock is something, Luke, that's still in the property area, but very different here in Australia. Lend-Lease, the big international property developer, Australia, Americas, UK, Europe and Asia, was going along beautifully and then stumbled a bit only a month or two ago, which traditionally always tends to do a stock like this, does it?
Yeah, I think when you get this close to your debt covenants, your share price is going to go down. So they're at 2.2 times interest coverage at the moment, and got 4.4 billion in debt. So this business is sort of on its knees a little bit. I'm not a big fan of kind of these turnaround investment stories. I also think that investing in something like this on a sort of an assets basis, or looking at the assets and where these things can trade at a discount for a long period of time, and you don't always get the realisation there. So, look, it's a sell for me. Too hard basket. Probably some others would disagree, and I totally get why it looks cheap to you. But for me, bit too hard, bit too risky.
It's a great brand name, isn't it, in that property space?
Is it, Koch?
I think it was.
It's been an institution.
You're showing your age.
Yeah.
It is. I'm going back to Dick Dusseldorp.
Yeah.
When he
Who?
the founder of it. No.
I'm sure if he still owned it,
fallen.
it'd have a better return on invested capital.
I'm sure it will. But God, it's fallen a long way, hasn't it?
I'll give you I'll show my age here. When I remember trading on the floor in the 80s, the old chalkboard floors.
Yes.
And
At
Lend-Lease,
Bond Street?
Yep, on Bond Street. And Lend-Lease was regarded as a top quality blue chip then.
Yeah.
But it was trading around $9 then.
Yep.
In the 80s. Still not far off that now.
And that stock exchange floor is now a gym.
That's right.
It's a fitness first gym.
That's right. So, this is a bit of a dog, I'm afraid.
Yeah.
We did pick it as a turnaround. It looked really, really good for a while. On the 18th of December last year, they came out and reconfirmed guidance. A couple of months later, they missed horrendously. How those people have still got jobs, I don't know.
So
just shocking. If they're over their business, what happened?
Yeah.
Awful.
And it's got to be, does that impact your confidence going forward? How long does it take for a company to rebuild
To me,
their confidence for you as an investor, a professional investor, after doing something like that?
It's easy. We don't own it now. We're out.
Yeah.
We took a small loss. I don't think they go back now until May, until they start talking to the market again. I won't believe what they say for a long time.
Yeah.
Simple as that. I don't need to be there. There's plenty of good stocks on the market. You don't need to be playing with that rubbish.
Yeah.
I think the
That's
rate
quite harsh words, but I'm afraid that's from December to February to miss like that is inexcusable.
I think in the REIT sector as well, the kind of exposure that you want at the moment isn't the kind that Lendlease gives you. I think if you want to buy stuff at a 20 or 30% discount to NTA, it's there in assets that are 98% occupancy and top end of Collins Street or top end of Martin Place sort of assets. So I think if you want to play, declining bond yields and a rally in the REIT sector on the back of that, there's safer, easier, and probably better sensitivity ways to do it.
And a comment that's been made a lot about Lendlease over the last sort of 2 years or so that I've been doing the call, 3 years, has been it's just a bit of a complicated business. Sort of they take big bets, and if they stuff one bit up, it really hurts a lot.
And it has been a case of when they stuff one of them up, not if.
Yeah.
They've just been getting it wrong.
Yeah. Look, do you look at complication in a business before you invest in it as well? Simpler the better.
Yes and no. I think in the context of, yes, simple to understand is helpful, but it means that everybody can understand it. I think that you've got to think about maybe where you can find a competitive edge and maybe look at something a little bit differently or a breakup value or these sorts of things. I think Lendlease, though, probably isn't where you should be spending your time if that's the kind of work you want to do.
Right, okay.
Yeah. I mean, if you think about what we talked about earlier with PEXA, where the stock's well priced on the Aussie side of things alone, whereas Europe could really kick it on, that's how you want to have the complication, or shall we say the question mark, all upside, not potential downside with Lendlease.
It's a really good point, Shawn.
Yep. All right. Jill wants a view, Luke, on ANZ Bank, one of our big four banks. All of the big four banks have been on a tear over the last couple of months. I noticed Macquarie, though, a week or two ago, put out a report saying Australian banks, this time it's different. And they were saying, well, it's not. They're trading at massive fundamentals. They're priced for perfection, and it's rare that a company ever achieves that. Yeah,
look, I wrote about this recently as well. Not going to win any clients or friends, but the big four banks are ridiculously overpriced at the moment. They're trading at, 1.5 standard deviations above long-term averages. Earnings are actually forecast to go down next year, sort of 5-10%, depending on what you read and your thoughts. But from my perspective, a flat sideways interest rate environment market, and a property sector that's kind of on hold, for lack of a better word, while there's no credit availability, I think doesn't bode well for loan volumes. You only sit there risking increasing bad debts and increasing funding costs in the interim. So I can't see margins really recovering as much as perhaps some of the people who are buying stocks today think. And for mine, I just think these things tend to mean revert over time, and there's just a lot of better stuff you can kind of own with more leverage to an upswing in property, if that's your view.
Right.
I'll probably point people to maybe AFG, Australian Finance Group, as a better way to play that recovery in housing volumes, which I think probably, like you said, Koch, will happen.
Yeah.
But I just don't think it's going to happen now, and in the interim, the banks could maybe go down 15%.
Okay. Look at that, 5-year highs. So you'd have a sell, take profits. Yep. Shawn?
We're long. We're staying long. It's up 13% this year. We're going to get a nice fat dividend in May.
Yep.
I don't expect a great deal more upside in the next 6 months, I stress. We've only got 12% of our growth portfolio in the big banks, big four, that's ANZ and NAB. So that's underweight for people that have a cross portfolio through. We're underweight the big banks, but We're very happy to have 6% in ANZ and NAB. It's really looked after us.
Right.
I don't think it's going to go a great deal from here. You know, it's going to pay the dividend in May. I'd be buyer under $28. If I had 10%, I'd be lightning above $30. But with 6%, happy just to stay where we are. So
Okay.
I'd call it a hold, actually.
So you're a hold.
Yep.
Would you be buying any more though?
Not at these
these
prices,
levels?
no. I'd be
No.
dips under 28 before the dividend. I'd be happy to buy a few.
Yep.
Obviously, that would come down to how well you can use the franking credits and things like that. And I'm
Yeah.
not going to talk about personal advice.
Yeah.
But I think they are. They've been defying people all year, Luke. To be fair, they've been grinding up on a regular basis. The market in lots of places is a bit overvalued historically.
Yeah.
I just think the banks look solid. I just don't think they're going to hurt us. But I wouldn't be buying here.
Right. So is this one of the classic cases? Like I'm nervous about different parts of the market and things like that. But is this a case of, yes, be aware that they've shot the lights out, just go along for the ride, be happy, but be nimble when they start to turn?
Well, I mean, I think I mentioned earlier that we think the markets are going up 3 steps back, 2 steps. So if it goes much above, $30, if you're an active investor, you could take a bit off the table looking to buy back under 28. I think you'll get both of those prices in the next 6 months without a shadow of doubt.
Yep.
Depends what you're trying to achieve.
Yeah.
Are you a trader? Are you an investor? Where are you? Where are you going? But
Yep.
you're going to get a good dividend in May. So if you were to buy it now, you're going to get 3 dividends over the next 13, 14 months. That's not too bad if you're an income player.
Yep.
So it depends what your motivation is. Would I buy it here for capital gain on its own? No, I wouldn't.
Right.
That's a big point to make.
Yep. But the Macquarie research, which I was reading, didn't include Macquarie, probably for obvious reasons.
Well, no, I
but-
don't think they can, right? But
No.
they were saying sell their own stock by definition.
Yeah. Would you be a seller of Macquarie?
We did sell Macquarie. So
Right.
when we went further underweight the banks, we kept the NAB in ANZ and we took off Macquarie because it's a higher beta play.
Yep. Yeah.
So in theory, it's the one that should come back the most.
Right.
Same. So like I said, I think the entire large cap banking sector is pretty overpriced at the moment.
Yeah.
And Macquarie's no different. Sure, it has a different sort of drivers of revenue, and I think maybe transaction volumes, like I said, start to pick back up this year, sort of in the ECM bank. But that being said, that might be offset with asset management or other parts as it has done over the last few years. So I think the earnings momentum in Macquarie has slowed. I think the
And they just lost one of their big earners, didn't
big
they?
infrastructure guy, yeah. I think,
and the commodity guy.
yeah. So look, I think that the business is the trick Macquarie ran for probably 7 years. There was really conservative guidance and consistently beating guidance, quarter after quarter, half after half. I think the market's kind of onto that now. I don't think you've got that kind of tailwind or safety net anymore. And yeah, look, I don't have any particular issue with any of the banks. I just think that they're businesses that aren't growing to justify the current valuation.
Right.
I think there'll be a price where you can get them for a better deal.
Okay. All right. And our final stock, Alan wants a view, Shawn, on corporate travel, the travel sector, one of the leaders in a lot of people's minds. Americas, Australia, New Zealand and Europe. What do you think of corporate travel? Is it your favoured travel stock?
Probably because it's the only one we own.
Right.
So I'd have to say yes. We recently bought it. So it came out with a pretty average result.
Yeah,
I'd like
you
to
saw
go as
the
far-
big dip
It came out
down
with a bad
there.
result.
Yep.
And the week after that, we bought the stock. So showing us a very, very small profit at the moment, but we bought the stock. We like it down here. We think it can grow its revenue, or it's intending to grow its revenue 5 times over the next 5 years. Sorry, double it over the next 5 years, I should say. Talk can be cheap, of course. We think they've got huge growth potential in the US, where it's got a very, very small portion of the market. So we see a lot of upside from these levels. I think the risk reward down here is very good, but it won't be a quick play. It won't be a quick turnaround. It's got to start kicking some goals now. It's got to come through in 6 months' time and steady the ship and start to deliver.
Right. So you'd be buying.
I
Is
wrote
this still a
down
buy
here,
at these
technically
levels?
good, buy dips under 17.
Okay.
So we did. So that's what we did.
Okay. All right. So buy under $17. Is it your preferred travel stock?
Yes,
Right.
because it's the only one we own.
Right. Why?
Why? We can't own the whole market.
No. Yeah.
You know, and we run concentrated active portfolios. Rarely have more than 20 stocks in the portfolio.
Yep.
So 5% in corporate travel is enough.
Okay. Lou?
Yeah, not for me. I think there's a few accounting red flags that kind of throw up for me. And I'm not sure this business is the best way to play travel from our perspective. We prefer Webjet. It's kind of operating on 50% EBITDA margins, and really like what they've done with their bed bank. We can see that business growing sort of for as far out as we can forecast at 30% per annum.
Bed banks like the booking.com.
Yeah, pretty much.
Yep.
So it's a very high return on invested capital business for them. And if that business can re-rate to the same kind of level as other businesses that trade on those kind of returns on invested capital, we're going to make a lot of money. So yeah, we're long Webjet, and I think it's a really good biz.
Okay, and not corporate.
Yep.
What about Qantas? What's your view on Qantas?
I'll give you a Warren Buffett quote, but no.
But then he did go in and buy airlines.
Yeah, sure. I think there's better businesses you can buy at the moment that play, the same sort of thematic, I suppose, for lack of a better word, without maybe necessarily the hassles that come with owning Qantas.
Yeah. I mean, I think they've got a new CEO. I think it should turn the business for the better. It's just going to take time.
Yeah.
It's like an oil tanker. You don't turn around overnight.
Yeah. And when you talk about lots of moving parts, airlines have a heap of moving parts, don't they?
She's trying to address the balance sheet problem with the points at the moment.
Yeah. All right. Okay, let's recap the final 5 stocks that have we've come through. Aurora, hold from Luke, a buy from Shawn. Global Data Center Group, a buy from Luke. A hold from Shawn.
Actually, no, I said buy, but I didn't know much about it.
Yeah. Did you say buy?
No, I said we like it. Yeah.
You like it? Okay. So you've got a buy.
Sold it to him, Kochi. I've sold it to
No, I think I made the comment. It's making all-time highs, so I can't. I have to like it.
But like Goodman, for exposure to data centres as they
that's
grow
it's where our money is.
Yeah. Lend-Lease, a sell from both of the guys. ANZ, take profits, sell from Luke, a hold from Shawn, likes ANZ. Corporate Travel, a buy under $17 from Shawn. From Luke, prefers Webjet in this market. Luke Luratip, good to see you, mate. Thank you for joining us from Seneca. And Shawn Hickman from Market Matters, good to see you, mate.
Good as always.
Now, if you've got any stocks that you'd like us to have a look at here, or for me to put to our expert panel, it's pretty easy. You just go to ausbiz.co/callpicks or write to us on Twitter or X. Tweet us on X using the @AusbizTV platform. That's it for the call from today. We'll see you same time tomorrow for another edition. See you then.
This program was brought to you by IG, Australia's #1 CFD provider. Trade over 17,000 markets with extended hours on key US shares and competitive spreads. All on an award-winning platform. IG, where traders are made.